Hi, Niro Pillay here from Investment Rise. And recently I've been getting a lot of questions about, is the Australian property market in a bubble? Well, first of all, to me, that question doesn't make sense because the Australian property market is not one market. And looking at that just makes zero sense to me. I mean, we're a country that's about the size of mainland USA. Just Queensland alone, which is not even our biggest state, is bigger than countries like the UK, France, Germany. It's like half the size of India. So we have a massive country with multiple different markets. Yet I see it time and time again. Someone says, oh, the Sydney market has risen by, say, 15%, Melbourne by 10, Perth by -3, and they average it all out and then they say, the Australian property market has risen by 7%. Really? I mean, who actually got that 7% growth? As I said, if you invested in Sydney, you got a lot more than that. And if you invested in Perth, you probably had negative growth. So how can you look at the Australian property market as one market? That doesn't compute. But the problem I have is that's exactly what some of the major banks are doing, the government, APRA, ASIC, all those powers to be are looking at the Australian property market. Are we in a bubble? How do we cool the Australian property market? But as I said, not all the states and all the capital cities and all our places have gone up in value. What they're really trying to do is cool the red hot Sydney market and maybe to a lesser extent Melbourne. But if you try and put in a scheme that's going to affect the entire country just based on Sydney, the problem is the country isn't Sydney. We have people living all around Australia. So why can't we do, for example, what our smarter neighbours across the ditch did, i.e. New Zealand? They looked at the Auckland market, which was red hot and skyrocketing. They went, all right, let's put in some cooling measures just for Auckland. Which means therefore someone like Wellington didn't get affected by what was happening in Auckland at the time. So why can't we look at measures that affect just the red hot markets if they want to make them cool, if they want to bring prices down, make them more affordable, which obviously will be helpful for first home buyers, but investors, not so much. But by putting in these measures that are going to affect everyone, you've got to start looking at investing differently. This is one of the things that I've been saying for a while, that the rules have changed in 2017 as an investor. And I think right now, if you're going to be looking to invest, and by the way, there are still some great opportunities out there to invest, don't get me wrong. And look, no, I've been saying it for a while that we should stay away from Sydney because like many people, I thought the Sydney market was overcooked, so at least 12 months ago, and it's just kept defying predictions. But to me, that's even a little bit scarier because if it does pull back, is that pullback going to be even worse? Time will tell, but certainly at the moment with the really low rental returns, which I'll come back to in just a second, yeah, investing in Sydney is something I'd be thinking twice about. So as an investor, what should you be looking at, especially if we're now going into a time of rising interest rates and different regulations from APRA, etc. One of the first things I'll be looking at is cash flow position. I'll be doing your cash flow numbers much more tightly. I'll be looking at, well, what happens if interest rates rises? What will your cash flow position be? Could you still afford that investment property? Yeah, sure, the bank is supposed to do that as part of their servicing, but really you need to know to do that because you know your cash flow better than anybody else. Secondly, I'd be looking at higher yielding properties. So anything with at least a 4% or above rental return, anything less than that's ridiculous. I mean, there are areas in Sydney right now that are giving you rental returns of 2% or less. Now, of course, you might be saying, oh, 2%, 4%, aren't they in the same ballpark, Niro? What's the big deal? Well, here's the thing. Imagine if you have a property that's giving you $700 a week rent, okay? And the way that numbers work out, let's just say that works out to be a 2% rental return. To make that rental return 4%, that property rent would have to go from $700 a week to $1,400 a week in rent. How likely do you think that is to happen? It's not, right? I mean, because rents are essentially a function of income. And already there are reports that rents are now starting to rise faster than incomes, which just cannot continue because people can't afford them. So looking at your rental return, the cash flow yields, terms that you've just got to be familiar with are so important. I believe that you've got to be looking for rental returns of 4% or higher in this new phase of the market that we're looking at, especially with the government trying to put in various regulations. But then you've got to also look at the capital growth potential. What's the population growth? What's the infrastructure growth? What's the jobs growth? All those key capital growth fundamentals. So in these times of government getting involved and government intervention trying to cool the so-called Australian property bubble, which makes zero sense, as I said at the start. Yes, the Sydney market is red hot and well and truly overcooked, I believe, and so is Melbourne to maybe a lesser extent. And so people are trying to make these prices more affordable. Sure, all well and good, but as an investor, you need to start looking at, if you're entering the market in 2017, where do you invest? What types of properties do you look to invest? Look at the cash flow returns, look at the rental yields, and then of course look at the capital growth. You've got to start being a little bit more strategic in 2017.